Hi. Let's learn about junk bonds. Junk bonds are bonds that carry a higher risk of default than most bonds issued by corporations and governments. A bond is a debt or promise to pay investors interest payments along with the return of invested principal in exchange for buying the bond. Junk bonds represent bonds issued by companies that are financially struggling and have a high risk of defaulting or not paying their interest payments or repaying the principal to investors. A high-yield, or junk bond is very similar to regular corporate bonds but differs because of their issuer's poorer credit quality. Junk bonds are risky since investors are unsure whether they'll be repaid their principal and earn regular interest payments. As a result, junk bonds pay a higher yield than their safer counterparts to help compensate investors for the added level of risk. A bond that has a high risk of the underlying company defaulting is called a junk bond. Companies that issue junk bonds are typically startups or companies that are struggling financially. As a result, junk bonds pay a higher yield than their safer counterparts because investors are compensated for the added level of risk. Investors buy junk bonds to profit from potential price increases as the financial security of the underlying company improves, and they also serve as a market risk indicator. Increased buying interest of junk bonds serves as a market risk indicator for some investors. Conversely, if junk bonds are selling off with prices falling, it usually means that investors are more risk-averse and are opting for more secure and stable investments. If the underlying company performs well financially, its bonds will have improved credit ratings and usually attract buying interest from investors. Conversely, companies that are performing poorly will likely have low or lowered credit ratings, and typically offer high yields to attract investors and to compensate them for the added level of risk. Investors can monitor a bond's level of risk by reviewing the bond's credit rating. Credit rating agencies measure the creditworthiness of all corporate and government bonds, giving investors insight into the risks involved in the debt securities. Credit rating agencies assign letter grades for their view of the issue, and bonds with a rating of investment grade come from corporations that have a high probability of paying the regular coupons and returning the principal to investors. Junk bonds have a higher risk of default because of an uncertain revenue stream or a lack of sufficient collateral. The risk of bond defaults increases during economic downturns, making these bottom-level debts even riskier. Tesla Incorporated issued a fixed-rate bond with a maturity date of March 1, 2021 and a fixed semi-annual coupon rate of 1.25%. The debt received an S&P rating of B in 2014 when it was issued. In October 2020, S&P upgraded its rating to BB from B+. This is still in junk bond rating territory. Despite the BB rating, the bond is trading at a very large premium to its face value, as it is convertible to equity and proves to be a valuable surrogate for the equity. Here are 3 key takeaways. 1. A junk bond is debt that has been given a low credit rating by a ratings agency, below investment grade. 2. As a result, these bonds are riskier since chances that the issuer will default or experience a credit event are higher. 3. Because of the higher risk, investors are compensated with higher interest rates, which is why junk bonds are also called high-yield bonds. Hope this would help. Thanks for watching.